Hello. Pull. Oh. Woo. Yeah. Woohoo.
Assalamualaikum. So today our group will be explaining about financial statement of Dashlady and FarmFresh. First, I will briefly explain the background of these two companies. Dashlady Malaysia is one of the most established dairy companies in Malaysia. It was founded in 1963 in Petaling Jaya and is part of Friesland Campina. In comparison, FarmFresh is a newer but fast-growing local brand. It was founded in 2009 in Johor by Lau Tuan Yi. Next, I will discuss FarmFresh cash flow capability for the years 2023 and 2024. In 2023, FarmFresh showed a very strong liquidity position. The current ratio of 4.61 and quick ratio at 3.61 indicate that the company had more than enough liquid asset to cover its short-term liabilities. This shows that FarmFresh has strong cash flow and low short-term financial risk. In 2024, liquidity remains strong. Although there was a slight decline, the current ratio decreased to 4.01 and the quick ratio to 3.46. This may be due to higher spending or reinvestment into operation. However, overall, FarmFresh has still financially healthy and able to meet its short-term obligation comfortably. For the next one is asset management efficiency. In 2023, FarmFresh showed weak asset management efficiency. This inventory turnover was 2.51, indicating slow stock movement. The average collection period was very high at 569.27 days, showing poor receivable management and cash flow issues. The total asset turnover ratio was only 0.36, meaning assets were not used efficiently to generate sales. In 2024, performance improved significantly. The inventory turnover increased to 4.86, showing faster stock movement. The average collection period dropped to 61.59 days, reflecting much better cash collection. The total asset turnover also improved slightly to 0.39, indicating better use of asset. Overall, FarmFresh operational system improved from 2023 to 2024.
Now, moving on to debt management for FarmFresh. In 2023, FarmFresh had moderate debt levels with a debt ratio of 0.39 and strong interest coverage, so showing low financial risk. While in 2024, the debt ratio increased to 0.46 and interest coverage weakened. Although the company is still solvent, it faces higher financial risk and needs better debt control. Next, for profitability trends for FarmFresh, while in 2023, FarmFresh recorded stable profitability with a net profit margin of 9% and reasonable returns. However, in 2024, the net profit margin declined to 7% while ROA and ROE remain unchanged. This shows weaker profitability and highlight the need for improved cost control. Now moving on to historical analysis of Dashlady. The first one is cash flow capability. In 2023, Dashlady showed weak liquidity with a current ratio of 0.80 and quick ratio of 0.32, indicating difficulty in covering short-term liabilities. While in 2024, liquidity slightly improved with the current ratio rising to 0.84% and quick ratio to 0.36, but both remain below the ideal level of 1.0. Next is the asset management efficiency. In 2023, Dashlady demonstrates strong efficiency with inventory turnover of 4.21 times, an average collection period of 23.54 days, and total assets turnover of 1.54 times. However, in 2024, performance declined as inventory turnover fell to 4.04 times, collection period increased to 30.66 days, and total assets turnover dropped to 1.35 time.
Now moving on to debt management. In 2023, Dashlady recorded a debt ratio of 0.54, indicating that 54% of its assets were financed through a debt. This reflects a moderate and management level of financial leverage. The company maintained a balanced capital structure, showing it did not overly depend on borrowing. With a time interest earned ratio of 97.65, operating profit were far higher than interest expenses, indicating a very strong ability to meet interest obligations. So overall, Dashlady faced a low financial risk and also maintained a stable solvency position during the year. In 2024, the debt ratio slightly decreased to 0.53, showing improved control over debt financing. Asset grew exceedingly liability, resulting in a strong and healthier financial structure. The time interest earned ratio increased significantly to 358.52, driven by higher operating profit and or lower interest costs. This sharp improvement highlight the Dashlady very strong solvency position, low financial risk, and conservation debt management approach. Next, for profitability trends. In 2023, Dashlady achieved a net profit margin of 5%, meaning the 0.05 ringgit of net profit was generated from every 1 ringgit of sale. Operating costs were well controlled. There was still room for improvement. The company recorded a return of asset of 8%, showing efficient use of asset to generate earnings. Meanwhile, a return of equity of 70% indicates strong return to shareholder. So overall, profitability in 2033 was stable and attractive. 2034, profitability improved with the net profit margin to 70%, reflecting a better cost control and operational efficiency. The return of asset increased to 9%, indicating more effective use of asset. However, the return of equity declined sharply to 2%, likely to do higher equity to retain earning dilutive shareholder return. So, despite the higher profit, shareholder return weakened and suggesting a more conservative capital structure. Now we're moving on to initiative action to improve financial performance. The first one is optimize cost efficient through technology adoption. Company should adopt automation and smart system and utility data analysis to reduce wastage and operational costs. Improved productivity will lead to a stronger margin and sustainability long-term financial performance. Second, strengthen product innovation and value-added offering, which is developing functional dairy product and apply a premium pricing strategy can increase profitability. This approach aligns with health-conscious consumer trend and strengthen market competitive. The third one is improve supply chain and inventory management. Better demand forecasting and lower inventory holding costs can improve asset utilization. A faster cash conversion cycle will ensure liquidity and financial stability. Lastly, reduce financial risk through better capital and debt management. Optimizing debt level and financial high-cost borrowing can reduce interest expenses. Effective capital management improves financial stability, investor confidence, and long-term solvency.
Starting with liquidity, FarmFresh clearly adopts a conservative short-term financial strategy. With a current ratio of 4.01 and quick ratio of 3.46, the company holds a high level of liquid assets, which allows it to comfortably meet short-term obligations and support business expansion. However, excessively high liquidity may also suggest that some assets are not fully utilized to generate returns. In contrast, Dash Lady records a lower liquidity ratios with the current ratios of 0.84 and a quick ratio of 0.36. Although these figures are below the ideal benchmark, they reflect Dash Lady's reliance on efficient cash flow, strong sales turnover, and stable operating cycles rather than holding idle liquid assets. When we examine asset management efficiency, Dash Lady shows a clear competitive advantage. The company's total asset turnover of 1.35 times indicates that it is highly effective in converting aged asset base into sales, which is typical of a mature and operationally efficient firm. FarmFresh, on the other hand, records a much lower total asset turnover of 0.39 times. This suggests underutilizations of assets, which may be due to recent investment in production facilities or expansion activities that have not yet fully contributed to revenue generation. In terms of a receivable management, Dash Lady demonstrates stronger credit control with an average collection period of 30.56 days. The company is able to convert sales into cash relatively quickly, supporting stable liquidity and reducing reliance on external financing. FarmFresh records a longer collection period of 61.59 days, which indicates slower customer payments. This could place pressure on cash flow and suggests that the company may need to strengthen its credit policies or collection process. Moving on to financial risk, the contrast between the two companies is very significant. Dash Lady records an exceptionally high time interest earned ratio of 358.52, indicating that operating profits far exceed interest expenses. This reflects extremely low financial risk and a strong ability to withstand economic or market fluctuations. FarmFresh, however, records a lower time interest earned ratio of 3.07. While the company can still meet its interest obligations, the narrow margin of safety suggests higher exposure to financial risk, particularly if operating profits decline. Finally, in terms of profitable, both company records the same net profit margin of 7%. However, profitability quality differs when we consider efficiency. Dashlady records a return on assets of 9%, showing that it generates higher profits from each ringgit invested in assets. This indicates strong cost control and effective operational management. FarmFresh record a lower return on assets of 3%, suggesting that although sales are growing, the company has not yet fully optimized its asset base to maximize profitability. Based on the overall analysis, Dashlady demonstrates stronger financial performance in terms of efficiency, profitability, and financial stability. Its lower liquidity ratios do not indicate weakness, but rather reflect a mature business model that prioritizes operational efficiency and disciplined financial management. On the other hand, FarmFresh shows strong long-term potential supported by excellent liquidity and rapid growth. However, its lower efficiency, slower receivable collection, and higher financial risk highlight the need for improvement in asset utilization and debt management. In conclusion, Dashlady is more suitable for stakeholders seeking stability, efficiency, and lower financial risk, while FarmFresh is better positioned for growth-oriented strategies, although this comes with a higher financial risk. And that's all from us. Thank you.